If you have $100,000 saved today, the next decisions you make could quietly determine your financial life for decades. In one future, that money grows steadily, compounds for years, and eventually becomes a $1 million portfolio supporting your freedom. In another future, that same $100,000 barely grows, slowly eroded by inflation, hesitation, and ordinary decisions that feel responsible. The strange part is the difference between those futures rarely comes from intelligence, talent, or even income. It usually comes from a few simple financial habits established right after someone reaches their first $100,000. I know this moment well because I remember exactly where I was the first time my account crossed that number. I was sitting alone in my car after work, scrolling through my banking app, refreshing the screen to confirm it was real. The number on the screen read $100,247, and I stared at it longer than expected. I assumed I would feel excitement or pride, maybe even relief after years of saving and sacrificing. Instead, I felt something else entirely. A quiet realization that I now had to make smarter decisions than before. Dati. Because reaching $100,000 is strangely uncomfortable if nobody has ever explained what happens next. Most people spend years focused only on reaching that milestone, but almost nobody teaches the strategy after arriving there. And that gap is where many financial journeys quietly stall, even though the person technically did everything right. So in this video, I want to show you exactly why $100,000 changes the math. We will talk about the hidden momentum of compounding, the common mistakes people make, and the system that builds real wealth. But before we go deeper, if you enjoy practical conversations about money, investing, and financial independence, consider subscribing to the channel. I share what I learn on my own financial journey, including mistakes, insights, and lessons that could help you think differently. You can also comment where you are watching from, or where you are in your financial journey right now. Some of you are approaching $100,000, others passed it years ago, and many are still climbing. Wherever you are on that path, understanding what happens after $100,000 might be the most important step. The first thing you need to understand is that $100,000 is not just a psychological milestone. It is actually the point where the mathematics of money begins to behave very differently from every dollar you saved before. Before this point, progress often feels painfully slow because most of the growth still depends entirely on your income. Every dollar arrives only after hours of work, discipline, budgeting, and saying no to things that looked tempting. But once your investments reach around $100,000, something subtle but powerful begins to change. Your money starts participating in the process instead of simply sitting there waiting for you to earn more. According to long-term market data from Vanguard, diversified stock portfolios historically return roughly 7 to 10% annually. To keep things simple, imagine your investments growing at an average rate of about 8% each year. If you invest $100,000 and the portfolio grows 8%, that creates roughly $8,000. $8,000 of growth appears without extra work, without overtime, and without negotiating another raise. When you break that number down, it becomes about $667 each month. That equals around $154 every week, or roughly $22 every single day. And suddenly, something interesting happens, because that money is being generated while your life continues normally. You might be working, sleeping, commuting, or spending time with family while your investments continue quietly growing. That is the moment when many investors realize their money has effectively started working alongside them. Before $100,000, the financial engine is almost entirely powered by your personal effort. After $100,000, the engine begins sharing the workload with the market itself. And once that shift begins, the pace of growth can accelerate in ways that surprise most people. This acceleration is the reason experienced investors often say the first $100,000 is the hardest. Not because earning it is impossible, but because reaching it requires pushing the financial engine uphill alone. Once the engine passes that point, something subtle happens because the market begins contributing more to your wealth each year. This is where many investors start noticing that their investment growth sometimes equals or even exceeds what they saved. And when that happens for the first time, the entire experience of building wealth begins to feel different. Because suddenly, your progress is no longer limited only by how much you can personally save each month. Instead, progress begins depending on time, discipline, and how long your investments remain inside the market. That is exactly why experienced investors emphasize reaching the first 100,000 as early as possible. Not because the number itself is magical, but because the compounding process finally has enough fuel. Once enough capital is invested, even modest market returns can begin producing surprisingly meaningful growth. But here is the uncomfortable truth most people do not expect when they finally reach this milestone. The biggest threat to your financial future after 100,000 usually comes from decisions that appear safe. In fact, the three most common mistakes people make after reaching 100,000 often feel responsible and reasonable. The first mistake is keeping the money sitting quietly inside a traditional savings account at the bank. At first, that choice feels safe because the balance never drops and the money always appears stable. But when we look at the numbers carefully, the situation becomes much less comforting. According to data from the Federal Deposit Insurance Corporation, the average savings account interest rate sits around 0.5%. Meanwhile, long-term inflation in the United States has historically averaged close to about 3% annually. When inflation grows faster than your savings interest, the purchasing power of your money slowly shrinks. So while your account balance still shows $100,000, that money quietly buys less each year. Over a decade, that difference can represent tens of thousands of dollars in lost purchasing power. And the most dangerous part is that the loss happens quietly without dramatic market crashes or warning signs. Because nothing dramatic appears on the screen, many people never notice inflation quietly reducing their real wealth each year. 10 years later, the account still shows $100,000, but its purchasing power may equal only $70,000. That is why experienced investors say cash sitting idle slowly melts away, even when the balance looks unchanged. The second mistake after reaching 100,000 usually looks like ambition, not fear, and that is the trap. People suddenly believe they must find a brilliant investment to speed up progress, instead of staying consistent for years. They research individual stocks at midnight, watch predictions, and chase whatever asset recently exploded upward across social media. The intention feels logical because everyone wants faster growth once they finally feel real financial momentum starting today. But the data on investor results paints a much less comforting picture than most people expect at this stage. Research firm Dalbar has tracked investor behavior for decades, comparing average investor returns with broad market benchmarks annually. Their findings show many individual investors underperform the market by several percentage points over long periods of time. They said, the cause is rarely intelligence, but emotional decisions during volatility, scary headlines everywhere, fear, greed, and constant uncertainty. Investors buy after prices surge, then sell after declines, locking in losses and missing the strongest recoveries later. Those reactions reduce long-term performance, even when the overall market trend remains positive and upward for decades. Over 30 years, a gap of only 3% annually can cost you hundreds of thousands of dollars. Picture two investors starting with $100,000 and investing steadily for the next 30 long years. One earns 8% annually, while the other earns 5% because of bad timing, doubt, and hesitation. The first may finish with over $1 million, while the second ends near $400,000. The difference was not the starting cash, but the discipline to stay invested and ignore the daily noise. This brings us to the third mistake that quietly breaks momentum after you reach $100,000. And surprisingly, this mistake has less to do with investing and more to do with your lifestyle choices daily. Quote, after years of disciplined saving, many people finally reach 100,000 and subconsciously believe they deserve financial breathing room. That sense of relief often appears through small lifestyle upgrades that feel harmless, but gradually weaken the momentum already created. Maybe the apartment becomes slightly nicer, the car slightly newer, or weekend spending becomes more relaxed than before. None of these changes feel irresponsible, which is exactly why lifestyle creep quietly expands without anyone noticing. Psychologists describe this behavior as the arrival fallacy, believing that reaching a milestone will permanently increase happiness. Kraut. In reality, the excitement fades quickly, and the brain quietly resets a new higher standard for comfort. Once that happens, spending slowly expands until it naturally fills the income and assets available. Economists often describe this pattern using a concept called Parkinson's law applied to personal finances. The principle states that spending naturally expands until it consumes the financial resources available to support it. Without realizing it, someone who reached 100,000 may suddenly stop pushing forward financially. Ikiit. They begin treating 100,000 as a destination rather than recognizing it as the starting line. 5 years later, their portfolio may have grown only slightly because contributions slowed dramatically over time. The tragedy is, they did not make a catastrophic mistake. They simply stopped maintaining the momentum. Momentum in wealth building behaves similarly to momentum in physics. Once movement begins, it becomes easier to continue forward. But the moment progress slows down, the system requires new energy again to restart financial acceleration. Kirte. This is exactly why the period immediately after reaching $100,000 becomes incredibly important. Because the habits established during this stage determine whether compounding accelerates or quietly stalls. Fortunately, the solution is not complicated, although most people expect something far more sophisticated. Building wealth after 100,000 usually depends on a simple financial system executed consistently for decades. And understanding that system may be one of the most valuable financial lessons you ever learn. Qs. To understand what to do next, we need to build a clear financial framework instead of chasing random opportunities. This framework is simple, practical, and designed to protect the momentum you worked years to create. Think of it less like a complicated investment strategy and more like a sequence of smart financial priorities. When executed consistently over many years, this system quietly transforms $100,000 into serious wealth. The first step is establishing a solid financial foundation before aggressively investing every dollar available. Barsargs. That foundation begins with an emergency fund designed to protect your financial life from unexpected disruptions. Life eventually delivers surprises such as medical bills, job loss, urgent travel, or sudden home repairs. Without a financial buffer, many people are forced to sell investments at the worst possible moment. That single mistake can destroy years of compounding progress and permanently reduce long-term returns. Financial planners typically recommend keeping 3 to 6 months of living expenses easily accessible in cash. For someone spending $4,000 monthly, that emergency fund might range between $12,000 and $24,000. This money is not designed to grow aggressively. It simply protects the rest of your financial strategy. Once that safety net exists, the next step becomes one of the highest return opportunities available. If your employer offers a retirement match through a workplace plan, you should capture every dollar possible. For example, many companies match 50% of your contributions up to a certain percentage of salary. That means contributing $6,000 could instantly generate $3,000 in additional employer contributions. Few investments anywhere offer an immediate 50% return before the money even enters the market. Ignoring an employer match is essentially leaving part of your compensation unclaimed each year. Once you capture that match, your financial system becomes significantly stronger and more resilient long-term. Now we can move to the next decision that often determines whether wealth accelerates or quietly stalls. Coin. The next decision in your financial system involves debt, and this is where emotions often overpower simple mathematics. Many people instinctively want to eliminate every debt immediately, but the smartest decision actually depends on interest rates. Debt charging more than 7% interest usually deserves aggressive repayment before serious investing continues. Paying off a 7% loan effectively produces a guaranteed 7% return with zero market volatility. Few investments anywhere offer a predictable return like that, without risk, uncertainty, or sleepless nights during market downturns. However, when debt carries lower interest rates, the financial decision becomes more strategic rather than emotional. Many mortgages issued in recent years carry interest rates between 3 and 5% annually. Historically diversified stock portfolios have returned closer to 7 or 8% annually over long investment periods. That difference suggests investing extra capital may outperform aggressively eliminating lower interest debt in many situations. The real goal is not eliminating every dollar of debt emotionally, but allocating money where probability works best. Once high-interest debt is controlled, the next stage focuses on maximizing powerful tax-advantaged investment accounts. These accounts exist because governments actively encourage retirement saving through incentives built into the tax system. One of the most powerful investment tools available in the United States is the Roth IRA account. Contributions into a Roth IRA are made using income that has already been taxed beforehand. The powerful advantage appears later because investment growth inside the account compounds completely tax-free. When withdrawals occur during retirement, the government does not tax those gains again in most cases. Current contribution limits allow many individuals to invest roughly $7,000 annually into this account. Over several decades, those consistent contributions can quietly grow into hundreds of thousands of dollars. Even more importantly, every dollar of growth remains protected from future taxes inside the Roth structure. Once these foundations exist, your financial system begins functioning like a genuine long-term wealth-building machine. After establishing retirement accounts like the Roth IRA, another powerful financial tool deserves serious attention from disciplined investors. Surprisingly, many people ignore this account, even though it offers one of the strongest tax advantages available today. The account is called a health savings account, often shortened simply to the letters HSA. At first glance, it appears to be designed only for medical spending, but its real power runs much deeper. Financial planners frequently describe the HSA as offering a rare triple tax advantage structure. First, the money you contribute reduces your taxable income during the year you make the contribution. Second, the investments inside the account compound over time without any tax applied to the growth. Third, withdrawals used for qualified medical expenses remain completely tax-free even decades later. That means the same dollar can receive 3 different tax benefits throughout its entire financial lifetime. Very few accounts anywhere inside the United States tax system provide advantages this powerful simultaneously. Many disciplined investors therefore treat their HSA like a hidden retirement account, rather than spending it immediately. They pay current medical bills with regular cash, while allowing the HSA investments to compound quietly. Years later, those stored receipts can be reimbursed, while the investments have grown significantly in the market. This strategy slowly converts healthcare savings into another powerful long-term compounding engine. Once these tax-advantaged accounts are operating correctly, your financial structure becomes much stronger. At that point, the investment strategy itself becomes surprisingly simple rather than complicated. Instead of chasing predictions, many experienced investors focus on owning broad sections of the global economy. This philosophy is usually implemented through diversified low-cost index funds covering thousands of companies. With only a few carefully chosen funds, an investor can own businesses across entire countries and industries. And that quiet diversification often outperforms the complex strategies many investors attempt every year. One of the most common versions of this strategy uses just 3 simple funds covering most of the investable world. The first fund typically tracks the entire United States stock market, including thousands of large and small companies. Funds like VTI from Vanguard allow investors to own nearly the entire American corporate economy in one investment. The second fund often focuses on international markets, providing exposure to companies across Europe, Asia, and emerging economies. A fund, such as VXUS, spreads investment across thousands of companies outside the United States. The third component sometimes includes bonds, which add stability during periods when stock markets become volatile. A diversified bond fund can reduce emotional panic because portfolios experience smaller swings during market uncertainty. Together, these 3 funds allow an investor to own tens of thousands of businesses around the world. Instead of betting on one company, you effectively participate in the growth of the global economy. Even more surprising, the cost of maintaining this strategy can be extremely small each year. Many broad index funds charge annual expense ratios close to 0.03 or 0.04% on a $100,000 investment that may equal only $30 or $40 per year. Compare that to actively managed funds which sometimes charge 10 times more while often delivering worse performance. Over decades, those small fee differences can quietly compound into massive differences in final wealth. That is why many long-term investors eventually stop searching for the perfect investment idea. Instead, they focus on owning the entire market and allowing time to perform the heavy lifting. When that system operates consistently, something remarkable begins happening to your financial trajectory. The portfolio that once felt small gradually grows until investment returns begin rivaling your annual salary. At $500,000, an 8% return produces roughly $40,000 of annual growth. And that is the moment many investors realize the real game of wealth building has truly begun. Imagine the moment your portfolio finally reaches $500,000 after years of consistent, disciplined investing. At that level, an 8% market return produces roughly $40,000 of growth in a single year. Suddenly, the market itself may be generating more wealth annually than many people manage to save from work. That is the moment when the experience of building wealth begins to feel completely different psychologically. Your money is no longer waiting quietly for your effort. It is actively multiplying the effort you already made. As the portfolio continues approaching $1 million, the mathematics of compounding become even more dramatic. At 8% growth, a $1 million portfolio can generate roughly $80,000 every year. That amount alone equals or exceeds the salary many professionals spend decades working to achieve. This is when investors finally understand that capital can work harder than the person who originally earned it. But reaching this stage rarely requires genius investing complicated strategies or perfectly predicting the market. Most people who eventually reach financial independence simply remain consistent longer than nearly everyone around them. They keep investing through boring markets, scary headlines, economic uncertainty, and temporary market declines. They resist lifestyle inflation and quietly redirect raises, bonuses, and extra income directly into investments. Over many years, those small disciplined decisions compound into financial outcomes that once seemed impossible. Eventually, the portfolio begins growing faster than the amount of money they actually spend each year. That quiet transition is the moment financial freedom stops being a dream and becomes mathematical reality. It no longer depends on hope, luck, or timing, but on time, discipline, and compounding. Looking back, the first $100,000 was never truly the finish line. It was simply the moment the financial engine finally gained enough fuel to accelerate forward. And from that moment forward, the real game of building wealth finally begins.